Okay, is this? Can you hear me? Sound check. Sound check. Wow, this is. Hey, Dad. Why don't you make sound? Can you hear? Yeah. I have no idea what's going. Okay, let's get on it. Anyways, uh, play that. Okay. Oh man. Alright, welcome to our Forex and CFD trading course. We're going to cover both lesson 1 and 2 actually. So I do hope everybody got to check our first 2 lessons, which is lesson 1 and lesson number 2. So in this we'll only be summarizing really. So first of all, we start by looking at the risk management. Okay, it is quite important that we look at the risk management all the time. So like we always say, trading foreign currencies can be a challenging and potentially profitable opportunity for investors. However, before deciding to trade on the forex market, you should carefully consider your investment objective, your level of experience and risk appetite. Most importantly, do not invest money you cannot afford to lose. I say this all the time to people who want to start trading forex. Do not invest money you cannot afford to lose. Mostly it is because forex has got a certain amount of emotional attachment with it. Okay, you will never get used to losing money. Okay, no matter how much it is, you can make 1,000 rands today and lose 200 bucks tomorrow. You will never get used to that, to losing that 200 rands. Okay, so do not trade with money you cannot afford to lose. Do not borrow people's money to invest into forex, okay? Because that will only increase the pressure. I tried trading with other people's money and I lost it, mostly because I think it was too much pressure or something. So again, do not invest with money you cannot afford to lose, okay? There is considerable amount of exposure to risk in any forex transaction, right? Whether you're trading for currencies, CFDs, or even a lot of people are trading Nasdaq nowadays. So you need to understand that, and you need to understand that what actually moves the market, what actually affects the market. So those are some of the things you need to understand. So I do hope you understand the risk warnings. Okay, I will not lie to you and tell you that you're gonna be a millionaire overnight. This is actually a process. So now that we have covered the risk management and the risk warnings, let's get straight to it. Okay, if you watch lesson 1 and 2, I'm sure you're now familiar with how the markets look. Okay, considering the fact that you are interested in trading forex, I'm sure you've seen the markets. Okay, now this is an example of a chart. All right, this doesn't represent anything, but this is how a chart looks like. Okay, the red candles represent the bull market, the bearish market, and the green candles represent the bull market. First of all, let's start from the top. Okay, we'll start covering this, the first things you need to know when it comes to trading. Okay, we'll start by covering that. We're going to look at a peep. Now, what is a peep? A peep is the smallest tradable price movement in a market. Okay, in any instrument, the peep is the smallest tradable price movement in the market. Okay, now looking at this Euro USD, the price of Euro USD, it's 1.3200, 1.3200, okay, meaning €1 is equals to $1.32, right? But then now we're trading, so we're looking at the 4 digits after the comma or the full stop, right? So the last digit, that is the pip, okay? If the market moves to 1.3201, it has moved 1 pip. That's called the 1 pip movement. So basically, in the Euro USD markets, we look at the last digit, the fourth decimal number after the comma, right? So we look at the fourth number, okay? That is our pip, okay? So if now you can see the market moved up to 1.3201, okay, that's a 1 pip movement. That's called a 1 pip movement. All right, I hope I'm making sense. You can see that it moved from 1.3200 and it moved to 1.3201. That's a 1 pip movement, okay? So that is 1/10 of a movement. So it moved, it's a percent, right? The decimal place may change depending on the instrument, though. Yeah. When we're talking about the pips, remember the pip is the smallest tradable price movement in the market, but the decimal number changes depending on the instrument. On most currencies, we're looking at the fourth decimal number. On other things, okay, we're also looking at a different. Okay, now in stocks, a pip is the second decimal number, and then in gold, it's also the second decimal number. In oil, it's also the second decimal number. In silver, it's the third decimal number. Okay, and then in forex, it's usually the fourth decimal number. That is, we're talking about currencies. Okay, so a 1 pip movement, it's when you look at the in stocks. Okay, if you want to see how many pips the market move, you look at the second decimal number. Alright, so if it moved, let's say you have 1 to 9 pip movement, you look at the second decimal number. Okay, so that's in pips. This really depends on the markets that you're looking at. So it is important to know what is a pip and to understand everything about pips. Okay, now looking at this, we can tell that you can see that the pip on this one is also the fourth decimal number. Okay, we have this pip, and then most people might be asking, what's this fifth decimal number? Okay, this small one. Okay, here, that's called a nano pip. We really don't look at that. Really, we don't look at that, but it is great to know what that is. So that's called a nano pip. Okay, now going back to that, we can see something, right? We have the price, we have the sell and buy price. Okay, we have the sell and buy value. Okay, they're not the same. Okay, the sell value is 0.071717, while the buy value is 0.0719. Okay, there's a difference in them. Now many people might be asking, why aren't they the same? Okay, the difference between the buy and sell value is called a spread. Okay, the spread is the cost of doing business. Okay, it's the money your broker charges you for using their platform. It is charged every time you open a position. Alright, most of the time brokers used to earn commission, but most platforms no longer have brokers, so the platform charges you. Okay, you are charged a spread to cover their costs. Okay, the spread is the difference in price between the buy value and the sell value. Okay, it's also calculated in pips or in points. Looking at this example, let's look at the example of Euro USD. Okay, we can tell that the sell value is 1.1072, while the buy value is 1.1074. Okay, now when you say the buy value minus the sell value, you get a 2 pip spread. Okay, so basically that is 2 pips. because it's going to be 0.0002. Remember, the fourth decimal number is our pip. Okay, it's our pip value when we're talking about what currencies. Now we can see that the spread in this case is 2 pips. So basically, whenever you open a position, okay, whenever you buy or sell currencies, you will be charged a 2 pip spread. Okay, most of the time when you open a position, it always starts on a negative. That is because that's the spread cost. Okay, I do hope that actually makes sense. Alright, so moving right along, in most cases the spread is determined by the number of people who are trading or the popularity of that certain instrument in the market. Okay, now currencies, most currencies are quite popular. Okay, a lot of people trade currencies because of their popularity, but so most currencies have a low spread. But when you look at the cryptocurrencies, most of them have a vast amount of spread. Okay, yes, cryptocurrencies are popular, but they haven't yet gained such popularity. They're still people are still skeptical about the future of cryptocurrencies, so that's why they have so much spread. Okay, and then we have leverage and margin. Leverage is a feature offered by the broker to help the trader to trade large amounts of securities or positions by having a smaller account balance. Okay, that is it. Okay, leverage is a feature offered by the broker to help the trader to trade with large amounts of securities or positions by having a small account. Okay, a broker might offer you leverage of 1 to 50 or 50 to 1. This means they allow you to access the market at 1/50th of the actual price. Okay, meaning you can trade a 50 bucks position with only a 1 rand deposit. Okay, to allow you to have access, they will require a deposit. Okay, this is called the margin, right? So being able to trade that 50 bucks position with one rand, meaning that is the leverage they're giving you, but then the 1 rand is the deposit, which is also called the margin. Okay, so a margin is a typical percentage figure. In this instance, it is 1 to 50, meaning it is only 2% of the overall required amount to open the position. So due to the great leverage, you are only required to pay only as a percentage of the trade. Okay, now looking at leverage and margin. Okay, most traders would give you different leverages. Okay, it can be 1-to-1, okay, which is zero leverage. Okay, 0% leverage. Okay, which is 1-to-1. That means you all whatever position you take, you will pay 100% of that money. Meaning you will be able to take a 100 position, you will be required to have what? 1 rand. In order to take a 100 position, you will be required to have what? 1 rand. Now, and then we have a 50-to-1 leverage or 1 to 50 leverage. Okay, meaning you can trade a 50 rand position with only 1 rand. Okay, now you can trade a 50 rand position with only 1 rand, and that means you only have to have 2% of the overall cost of the position. Okay, now and then we have 100-to-1 or 100-to-1 or 1-to-100 leverage. Okay, 100-to-1, that means you can trade a 100 rand position with only 1 rand. That means you are only required to have 1% of the overall cost of that position. And then we have a 200-to-1 leverage, which means you only have to have 1 rand in order to trade a 200 rand position. So you only have to pay 0.5% of the overall cost of that position to take the position. So and then we have 400-to-1, which means you can trade a 400 rand position with only 1 rand. Okay, in order to open a 400 rands position, you only have 200, which is the required margin or the initial deposit. Alright, so give me a second. I don't know. All right. So moving right along. We have lots. Okay. Now what is a lot? Okay. There's a standard lot, contract size, whether you're trading forex, CFDs, or commodities. Okay. And then we have 3 tradable lot sizes. Okay, we have a standard lot, we have a mini lot, and a micro lot. Okay, a standard lot, it's one lot, and then a mini lot is 0.10. Okay, it's 0.10 lots, and then a micro lot is 0.01. Okay, now lots most of the time, a lot of trading companies or a lot of trading brokers use lots. Okay, lot sizes are quite important, especially when you're trading on the MetaTrade 4 and 5. Okay, when you're trading on the MT4 or MT5, they're mostly using lots. Okay, and other companies which have their own platforms use lots. So it is a great idea to understand lot sizes. Okay, meaning let me give you a practical example. Okay, now this is whenever you're trading, if you've ever traded on an MT4 or MT5 platform, you will see something like this whenever you're opening a position. So now this is a Euro USD currency pair. Okay, the volume. Okay, the volume. This is where you get to change your lot size. Okay, now this is 1.00, which means it's a standard lot. Okay, and then we have a mini lot. Okay, you'll have to change your lot size here. Okay, that is on the volume area. And then we have a mini lot which is 0.10, and then we have a standard lot, a micro lot which is 0.01. I hope that is clear so far. Okay, if you have any questions, please do not hesitate to ask. I will be really happy to answer any of the questions. Okay, because I don't want any confusion. Yeah, and then let's see. Now in trading, a standard lot is a set trade size. Okay, that means in MT4 that is the default. Okay, you have to adjust it yourself. They don't adjust it for you. Okay, so if you were to buy one standard lot of Euro USD, that means you will be buying $100,000 or 100,000 euros worth of dollars. Okay, and if you were trading gold, okay, to trade a standard lot, that means you will be trading 100 ounces of gold. Okay, that means it's a standard lot. Okay, it's a full thing, it's one thing. Alright, a mini lot is 0.10, and then meaning you'll be trading 10 ounces of gold. Okay, and then micro lot, it's 0.01, meaning you'll be trading 1 ounce of gold. Okay, now let me try a more clear example. A standard lot, it means you will be trading 100% of that thing. Okay, and then a mini lot, it means you'll be trading 10% of that thing, and then a micro lot, you'll be trading 1% of that thing. Okay, so to better understand lots, you have to think of them as some sort of percentages. Okay, a lot of people don't like to use that, but to me it makes clearer sense. Okay, because especially when it comes to gold and other things. Okay, looking at this, at when we come to currencies, okay, to trade a standard lot, which is one lot, okay, you would be buying 100,000 euros worth of Euro USD. Now that's a Euro USD currency pair. Okay, to trade a standard lot, you'd be trading 100,000 euros worth of Euro USD. Okay, now that 100,000, think of it as 100%. Okay, and then to trade a micro lot for that, a mini lot for that, it means you'll be trading 10% of that. So meaning you'll be trading 10% of 100,000 euros, meaning you'll be trading 10,000 euros. And then a micro lot, you'll be trading 1% of an entire standard lot, meaning you'll be trading $1,000, 1,000 euros worth of dollars. I hope that makes perfect sense. When it comes to gold, standard lot, it's 100 ounces of gold, while a mini lot, it's 10 ounces of gold, which is 10% of an entire standard lot. And then a micro lot, it's 1 ounce of gold, which is 1%. All right, now let me give you a clear example. All right, let me give you a clearer example. Now I'm gonna mix up the lot and leverage, okay, of gold. Let's say we're trading gold. All right, let's just say gold is trading at $1,100 an ounce. Okay, say gold is trading at $1,100 an ounce. All right, to trade one lot, which is a standard lot, which is 100%, which is 100 ounces. Okay, to trade one lot of gold, which is 100 ounces, means you'll be saying 1,100, which is the price of 1 ounce, multiplied by 100 ounces. So in order to trade 100 ounces, you will need to have $110,000 in your account. All right. Now, so to trade one lot, you'll need to have $110,000 in your account. Okay. This is the margin required to place one trade, whether you're buying or selling gold. Okay, it means you'll have to have $110,000. Now, a lot of normal traders don't have that. Okay, a lot of people don't have $110,000 to open one position. Okay, that is insane. That is totally insane. That is trading without leverage. Okay, that is trading on a one-to-one leverage. That's the money you have to have in order to open one gold position. Okay, a one lot worth of gold position. Okay, now let's just say the broker offers you a 1-to-50 leverage. Okay, that means you only have to have 1/50th of that whole amount. Okay, that means you only have to have 2% of that whole amount. So all you have to do is say $110,000 multiplied by 2%, meaning you no longer have to have 110,000 to open the position. You only have to have a required margin of $2,200. Like I said, leverage actually allows you to trade the markets, to trade large size position with only a small amount of money in your account. So leverage actually works for you. Okay, leverage is a brilliant thing when you know what you're doing, but it can also turn out to be your worst enemy when you don't know what you're doing. So leverage positions actually help you trade easily. Now remember, when you're trading without leverage, that can be quite hard. Okay, let's say you have $5,000 in your account. Okay, and you wanna buy $5,000 worth of gold. Okay, remember, price of gold will be what, $1,100 per ounce. Okay, so you wanna buy $5,000 worth of gold at $1,100 per ounce. So what you have to do is just say that 5,000 divided by 1,100. Okay, meaning you will only have 4,5454 ounces of gold. Okay, now the price of gold, let's say you turn out to be absolutely right and the price of gold rises to $1,150 per ounce. Okay, now your gold is worth more. Okay, now remember you have 4.545454 ounces. Okay, that you bought. Now the price of gold has risen to $1,150 per ounce, meaning now you owe, to get how much money you actually made, you have to say $1,150 multiplied by the number of ounces you have, which is 4,545454. You've just made yourself $227.27. Okay, that's your profit. But remember, you risked 5,000. Okay, you made $227.27 profit, but you have risked 5,000 rands. Okay, now you risked $5,000 for a return of $227.27. Now, would you say that was a good trading decision? Would you be happy to take such a position? Okay, to risk so much in order to gain so little. Would you do it? Most of the people would say no, because that's actually a bad idea. Okay, you can't risk 5,000 and not even make up, not even 1% of it. Okay, because 227.27 cents, it's actually round about how many percent? It's 0.47%, if I'm not mistaken. So it's actually quite costly. So while we're moving right along, now let's just say now you're trading with margin. Remember, on that trade you're trading without margin. Now you're trading with margin, right? On that previous trade it was 1-to-1 leverage. Okay, you were trading with leverage, which was 1-to-1. Now you're trading with leverage. That one, it was without leverage, which means you were buying clean. Okay, now you want to buy gold, which is still at $1,100 per ounce. Okay, but now you have a leverage of 1-to-50. Okay, you want to buy 100 ounces of gold, which is one lot. Okay, you want to buy a standard lot worth of gold, which is 100 ounces, meaning you will need to have what, $110,000 into your account. But just because it was leveraged, your required margin is only 2% of the entire cost of gold. So you're gonna say $110,000 multiplied by 2%, which is $2,200. Okay, and just as before, gold rises to $1,150 per ounce, which means gold has gained $50. Okay, it has gained by $50. Okay, it was $1,100. Now it has risen to $1,150. Okay, remember now you don't have 4,5454 amount of gold. You have 100 ounces. You remember you bought 100 ounces. Okay, you bought 100 ounces for how much? For $2,200. This is trading with leverage. And there you bought $5,000 worth of gold, but you only had 4,5454 ounces. Now you bought 100 ounces. Okay, that's the power of leverage. You bought 100 ounces at 1,000 at one at $2,200. Okay, we have 100 ounces of gold at $2,200, and gold has risen by $50, and you have 100 ounces of gold. That means it's $1,150 multiplied by 100 ounces, which is 1,100, which is 115,000, which is $115,000. Now to check your profit, you will have to minus that $110,000. You're gonna say $115,000 minus $110,000, which means you have made a profit of $5,000. You have made a profit of $5,000. Okay, that is $5,000 worth of profit after risking how much? $2,200. You risked $2,200 and gained $5,000. Now that is something to be really proud of. Okay, that is something to be really proud of. Now, if I may ask you, would you risk $2,200 to gain $5,000? Exactly, a lot of people would risk that, but would you risk $5,000 in order to gain $227? Most people would say no, I would never. Okay, that is the power of leverage. Okay, that's the power of leverage. But here's a little warning: there is a disadvantage of trading with leverage if you don't understand the risk management. Okay, trading leverage requires you to know what you're doing. Yeah. You need to understand risk management. Okay, don't trade with leverage if you don't know what you're doing. That's why a lot of traders lose, because they don't have a risk management strategy. You need to have a risk management strategy before you can start trading with leverage. Okay, do not start trading unless you have a risk management strategy. That is really important. Okay, because if you're trading with leverage and you don't have a risk management strategy, you could face a margin call. Okay, and if you've ever blown your account before, I'm sure you know what is a margin call. But if you've never traded before, a margin call occurs when your open position encounters so much loss that the broker alerts you and closes the trades. Okay, in order to have a position open, you need to have a certain amount of money in your account or in your equity. Okay, so you need to have a certain equity or balance in your account in order to keep your open position going. Okay, but if your position loses so much that you have zero equity, the broker will alert you and close your position. Okay, and this usually occurs when you don't have a risk management strategy. Okay, now if you're a professional, this should never happen. Okay, if you're a professional, this should never happen when you're a professional, because you understand your risk management strategy. Okay, when it comes to your risk management strategy, it means you have to understand when to open a position, how much to risk, what kind of trades to open, what not to trade. You need to understand all of that. You need to understand all of that. Alright, so far I do hope you guys understand. So far I really hope you guys understand where we're at, and I really hope you do understand where we're at this moment. As we keep moving along, alright, now what can we trade really? Because a lot of people have been asking that, what can we trade? Okay, what can we trade? What can we trade? All right. When it comes to trading, we can trade a lot of different instruments. Really, we can trade a lot of different instruments. Starting with forex. Okay, we can trade currencies. Okay, currencies is another name for forex. Okay, now here's one thing I need to clarify. A lot of people consider themselves forex traders, while in fact they are not forex traders. Forex is was abbreviated from foreign exchange. Okay, foreign exchange, which is currencies. Okay, if you don't trade currencies, you are not a forex trader. You're actually a CFD trader, which stands for currency for differences. Okay, a lot of people consider themselves forex traders, but a lot of them don't even trade forex. Okay, so you are not a forex trader if you are not trading forex. Okay, you are not a forex trader if you are not trading forex. Now, what can we trade? We trade foreign exchange. Okay, we can trade foreign currencies. All right, let's see. Okay, we can trade forex. Okay, the forex markets are very liquid, which means they are very popular, matured, and developed. That is the foreign markets. Foreign markets are very liquid, matured, and developed. You can enter and exit trades easily, rather than wait for a counterpart. Okay, meaning you don't have to trade with a broker. You can just trade them by yourself. Okay, you do have to have a brokerage company or a CFD provider or a trading company to trade with, but you don't have to be appointed a broker from that company in order to be able to trade. That means you can trade them by yourself. Okay, many traders are familiar with their own currencies when compared to other currencies. Meaning, if you have any idea of the exchange between the dollar and the ZAR or the rand, or if you're familiar with the euro and the dollar, or the pound and the dollar, or the Swiss franc and the dollar, or the Australian dollar with the dollar, or the Canadian dollar with the dollar, you have an idea of how to trade currencies. Okay, even though you still need some more knowledge, but a lot of traders can trade currencies pretty easy. Okay, they are easy to understand and they are very popular, which means they have a low amount of spread. They are easy to understand because most of them you can trade them using technical and fundamental analysis. Okay, we will get on that as we go along, but you can trade them easily. Okay, they're easy to trade as well. Okay, traders can relate to the trajectory of currency based on economic factors. It means they are affected by politics mostly. Okay, they're affected by politics. So whatever that's happening around the world affects forex or affects currency. Okay, when you can there are a lot of countries. If you had looked at the currencies during the coronavirus pandemic, you would see something. The US dollar started gaining, okay, crazily so, until Trump said a lot of things which sent the dollar falling. Okay, the dollar fell after Donald Trump said some other things. Even the Chinese yuan, the time China was struggling with coronavirus, the currency was falling because a lot of things were happening. Okay, a lot of countries started locking down the country. Okay, when lockdown occurred in many countries, those countries started losing their currency, started losing value. So those are some of the things that affect the dollar. So you do need to understand those kind of things. Okay, those are things that affect the currencies. All right. Okay, a lot of currency pairs have low spread, just like I said, and then we have commodities. Okay, Commodities, we're talking about energies, which is oil, Brent crude oil, natural gas, and then we have metals, which is platinum, gold, silver, copper. Okay, those are the metals. And then we have soft commodities, which include coffee, soybeans, corn, wheat, etc. And then we have more soft commodities, which we're talking about sugar, livestock, and cocoa. Okay, now let's have a breakdown of these commodities. Okay, let's look at energies. Energies are highly volatile instruments. This is because they are mostly driven by two major factors. Location, which is on the top of the list. Locations. They are often produced in areas of political and economical instability. Okay, creating side difficulties. Okay, creating supply side difficulties. Okay, they are mostly found in North Africa and the Middle East. Okay, when you can look at the wars, the politics that's in those locations, it's crazy. Okay, the oil prices is mostly affected by location. Okay, another thing that affects them is the global outlook, which is microeconomics dictate assumed future demands. Okay, in if recovery stalled, markets would anticipate less demand. Okay, if you check during the COVID-19 pandemic, okay, the oil price fell because the demand actually took a dive. Okay, a lot of people were no longer driving to work. A lot of people were working from home, meaning the oil demand went down. So the oil price also went down. Okay, the supply went up, but then the demand went took a dive. But when countries started recovering from the COVID-19, oil prices started gaining again, mostly because now the demand started to increase. Okay, and then we look at precious metals. Okay, we're talking about platinum, gold, silver, copper, palladium, etc. All right, metals are quite volatile. Okay, as sentiment swings. Okay, and traders tend to flock to gold in time of hardship. Okay, this is called a flight to safety. Okay, there's been news that China and Russia have been buying gold like crazy because they believe people lose confidence in the US dollar and stuff. But that's some of the things. Okay, a lot of people go and buy gold because they do believe things might turn out to be crazy and gold might be the only stable currency that's out there. Okay, so they're quite volatile and they have a low amount of spreads and they're too popular as well. So a lot of people trade gold. Okay, they trade commodities. And then we have soft commodities. Soft commodities are pulled from the ground. Anything pulled from the ground and that's eatable, those are soft commodities. Okay, like energies, they offer some excellent moves as underlying factors affecting movement tend to change quite rapidly. This typically happens through one or more of the following factors: supply and demand. Okay, now let's look at the supply. Supply, when we talk about the supply is mostly affected by weather patterns affecting produce regions. Okay, now most people would give you examples about Africa, saying Africa is too hot and it is largely affected by droughts, lack of rain, and I think it was about 3 months back when it had a high locust infestation. Okay, like there was billions and billions of locusts eating their crops, which means the supply took a dive and the demand went up. So the price of soft commodities skyrocketed. Okay, a lot of people were buying simple day-to-day soft commodities like coffee and other stuff. They were buying them at an expensive price. Okay, coffee that used to be, let's just say, 56 bucks, it went up to 100 and something bucks. Okay, mostly because the supply took a dive and the demand increases. Okay, Okay, and just like I said, the pest-related matters affecting the crops, which happened in Central Africa somewhere early this year. All right, and then we have demand. Okay, the global demand based on the economic outlook. Right, when the global demand increase for a certain thing, the price actually skyrocket. Okay, most people are, if you ever follow the price of commodities, rooibos was quite was in low demand before 2013, but post 2013 the demand for rooibos increased, and the rooibos prices increased as well. So the increase in demand result in the increase in price. Okay, and the decrease in price. Okay, safety concerns resulting to consumption of particular commodities also plays a major role in these commodities. And then we have stocks and indices. Okay, stocks interchangeably with equities. Okay, since equities are traded on an exchange, they have an opening and closing time for trading. Okay, shares and equities are designed to raise operating capital for the issuer. Okay, speculators invest to gain a return. Okay, those are stocks and equities. We're talking about Google, Apple, Facebook, etc. And then we have indices. Okay, indices, we're talking about the S&P 500, which is the 500 biggest companies in the USA. We're talking about the German 30, which is the top 30 German companies. We're talking about the FTSE 100, which is the top 100 UK companies. And then we're talking about the ASX 200, which is the 200 biggest Australia. We're talking about US 50 and all the others. Okay, market indices are essentially groupings of the top listed equities of a particular exchange, market, or region. Okay, the average value is similar to the relative price. Okay, so indices is actually a grouping of the top listed companies in a particular region. Okay, like the S&P 500 is the top 500 companies in USA and etc. And then we can also trade cryptocurrencies. Okay, we're talking about Bitcoin, Ethereum, Neo, Litecoin, Ripple, you name it. Okay, so cryptocurrencies tend to be quite volatile, mostly because a lot of people, like, whenever you remember the Bitcoin era, or whatever they call it. So a lot of people were buying Bitcoin like crazy. Okay, and then we had the Bitcoin crash, which left a lot of people broke. Okay, which were the latecomers. And then, okay, they aren't yet matured, so they have huge spread, meaning they are somewhat expensive to trade. Okay, I know a lot of people would tell you, like, buy Bitcoin, this is the best time to buy Bitcoin, but then when you're trading Bitcoin can be quite expensive. Okay, it is quite expensive, mostly because it has huge amount of spread. Okay, they are on many platforms. Cryptocurrencies are open 24/7, which means you can trade them at any time. Okay, you can trade them at any time. You can trade cryptocurrencies at any time. And we have government bonds. Okay, government bonds happen in this manner. Governments have borrowing requirements in order to run their affairs. Okay, some manage to do this better than others. Okay, they go to the marketplace seeking funding for a fixed period. Okay, this could be anywhere from 1, 3, 5 to 10 years. All right, the markets dictate the price given the economic outlook for a particular region. Okay, and the commercial outlook in general. Okay, so meaning the borrowing requirement for Sweden, okay, compared to the borrowing requirement for, let's just say, Congo, the one BSA, okay, Sweden might be given lower interest rate or more years to pay the money back, or while Congo might be given higher interest due to the level of risk involved in investing in Congo. Okay, they know, most people, like, they know that Sweden might pay the loan faster due to the fact that it's a first world country and all the other things, while Congo is still struggling and it's considered a third world country. And they, considering the amount of risk in investing in Congo, you know, they might say, you know what, it's too risky, all the other things. And so when there's greater risk associated with the region, the rate becomes higher as investors demand greater yield to justify the acceptance of the risk. Okay, you can trade bonds via the CFD markets. Alright, so far we have covered the first lesson. Okay, that actually covers lesson number 1. Okay, we've covered the P value, we've covered spread, we've covered leverage, we've covered margin, we've covered things you can trade. And so that's actually what lesson number 1 is all about. And then we're going to go on to lesson number 2 in a moment. Okay, so remember, what can you trade? You can trade currencies, you can trade commodities, you can trade bonds, you can trade stocks and indices, and you can also trade cryptocurrencies. Okay, remember, these are all things you can trade. Now we are moving on to Japanese candlesticks. Okay, we are moving deeper into trading. We are moving deeper and deeper into trading. Okay, now before we move on to lesson number 2, are there any questions first? That's one thing I'll let you know. Are there any questions? Alright, before we move on to that, before we move along, before we move on to candlesticks, alright, Japanese candlesticks. Japanese candlesticks are indicators used in the financial market to represent price movement of a financial instrument over a specific period of time. Okay, here's an example of a Japanese candlesticks. This is how a Japanese candlestick looks like. Okay, we have Japanese candlestick group show us the movement over a specific period of time. Okay, we can have 1 minute movement, 1 hour movement, 1 day movement, 1 week movement. Okay, one Japanese candlestick could represent a minute, an hour, 15 minutes, 30 minutes, 1 day, 1 week, and even 1 month. Alright, that's what the one Japanese candlestick can represent. Okay, now looking at the Japanese candlestick, we have the high price, we have the open. Okay, we have the open price, and then we have the low price. Okay, and then we have the high price, and then we have the close price. Okay, that's what we have. Okay, the lower shadow, which is the lowest price, the high shadow, which is the highest price, and then we have a real body, an open and a closed price. That's a whole entire Japanese candlestick. Now we have a bullish and bearish candlestick. Okay, we have a bearish and bullish candlestick. Okay, mostly a bullish candlestick will be green, while a bearish candlestick will be red. Okay, now looking at this candle, we have the open price here, and then we had the low price here. Okay, the lowest price of which the market moved for that particular period, and then the highest price which the market reached at that particular period, and then we have the close price. Right, and then on the bearish candle we have the open price, we have the highest price, we have the lowest price, and then we have the close price. Okay, now let's look at the bearish candlestick on a more detail. Okay, the bearish candlestick, when we can look at something, it opens at this point. It always opens at the bottom. Okay, think of it like a bearish candle. It's an upward moving candle, so basically it has to open at a certain point, at a lower point, and close at a higher point. Alright, now let's just say the candle opened here. Okay, it opened at $80. It opened at $80. Okay, and then as it opened at $80, it went down to $60, but didn't close. Now it was still open, and then after a couple of minutes, it rose to $120, but then it closed at $100. Okay, now looking at this candle, okay, let us just say it's a 5-minute candle. All right, it opened at $80. Okay, let's just say at 10 o'clock. At 10 o'clock it opened at $80, and then at 1 past 10 it was at $60. Okay, and then at 4 past 10, at 3 past 10 it started rising, and then at 4 past 10 it was at $120. That's 4 past 10. And then since the 5-minute candle, at 5 past 10 it was at $100 and it closed. Okay, that's a 5-minute candle. It opened at 10 o'clock, it was at $80. It opened 1 past 10, went down to $60. Then 4 past 10, 3 past 10, it was still rising. And then 4 past 10 it went to 120 high, and then at 5 past 10 it closed at $100. Okay, now where do you think that the next candle will open? The next candle will have to open at the previous candle's close. Okay, at this point the close was at $100, meaning the next candle will open at $100. Okay, now let's look at the bearish candle. A bearish candle, since it's a downward moving candle, it will have to open at the top and close at the bottom. Okay, now remember the previous one closed at what? At 100, meaning the next candle will open at $100. Now let's look at this as a 5-minute candle as well. Okay, it opened at $100, and then it rose to $120. Okay, and then at a certain period, at a certain time, it went down to as low as $60, but then it closed at $80. Now looking at this, we can say it's a 5-minute candle. Okay, now remember at 5 past 10 that one closed, and then at 6 past 10, since this is a 5-minute candle, so at 6 past 10 it also opened, another candle opened at $100. Alright, and then at 7 past 10 it rose to 120. 7 past 10 it rose to 120. 8 past 10 it was still moving, and then at 9 past 10 it was at $60. 9 past 10, but then it managed to move up a bit, and at 10 past 10 it closed at $80. 10 past 10 it closed at this point. Candle closed at $80. Now this is a bearish candle because it closed up here, it opened up here and closed down here. So it's a downward moving candle, meaning the bears were pushing. Okay, the bears are strong, the bears are pushing down. Okay, and then the next candle will have to open at what? At the previous candle close, which is $80. So next candle will open here at $80. Okay, now we have a lot of different Japanese candlesticks. We have different types of Japanese candlesticks. Okay, we have a hammer. Okay, a hammer. Okay, we also have a bullish and a bearish hammer. Okay, the bullish hammer is called an inverted hammer or a shooting star. Okay, now since it's a bullish candle, okay, it's a hammer but it's a bullish candle, meaning it has to open at the bottom and close at the top. Okay, it opened here, then it rose up. Okay, it went up to the highest point and then it bounced down again and then it closed at this point, meaning the open and the lowest price are the same. Okay, they might be slightly different but most cases are the same. All right, so this is a bullish candle. Okay, now depending on the market trend, okay, a hammer is bearish in an uptrend. When we see a hammer in an uptrend, it might be signaling a change in the market or a turn in the market. Okay, the hammer always hammers the market in a different direction. A hammer always hammers the market in a different direction. When we're in an uptrend, okay, in an uptrend, the hammer will hammer the market into the opposite direction. So basically, a hammer is bearish in an uptrend and bullish in a downtrend. Okay, now let's look at the bearish hammer. Okay, which is also called a hanging man. Okay, this looks like a man and it's hanging. So this is a bearish hammer. It opened at that point. It shot down to the lowest point and then it rose up again, pushed up to the highest point and then it closed right here. Okay, it opened in the upside and closed at the bottom side of the price movement. Now, depending on the trend, remember the hanging man is bearish in an uptrend and bullish in a downtrend. Now, I'll give you a more practical example. Okay, a hammer hammers the market in the opposite direction. Okay, remember, a hammer hammers the market in a different direction depending on a trend. When in an uptrend, it triggers a downtrend movement. When in a downtrend, it triggers an uptrend movement. Okay, now in order to determine whether the hammer is strong enough to influence the market, the market movement, the wick has to be at least twice the size of the body. Now this is the wick. Okay, the wick, we're talking about the tail. Okay, and then this is the body. Now you can see that this wick, by looking at it, you can tell that it's almost twice the size of what? Of the body. Alright? It's almost twice the size of the body. Now let's look at a more practical example. Okay, remember the hammer influenced the market. You can see, okay, this was a downtrend. Okay, we had bearish candles. Okay, the bears were pushing the market down. Okay, the bears were pushing the market down. Okay, the bears were dominating the market. Okay, they were dominating, and then we had a what? We had a hammer. Here, at this point, we had a hammer, and it hammered the market into the opposite direction. It hammered the market into the opposite direction. Okay, it influenced the market movement. It hammered the market in the opposite direction. and then the market changed, and then we had an uptrend. Okay, the bulls started taking over with an uptrend, and then another hammer. It hammered the market into the opposite direction. And then all of a sudden we had the market they changed direction, and the bears started taking over. And then we had another hammer, which hammered the market in the opposite direction. And then the bulls took over again. And guess what? You can see there's another hammer here. What do you think is going to happen? Of course, the market is more likely to change because the hammer will hammer it into opposite direction. Okay, and then we have what is called a doji. Okay, a doji is also called a doubt candle. Okay, a doji is also called a doubt candle. It represents indecision. When you see a doji, it is wise to wait until the market gives you confirmation. Okay, you don't have to act, you have to wait for the market to give you direction. Now look at the doji. It opened here, the market opened here, then went to the highest point, then the lowest point, and closed at the exact same point where it opened. That's a doji. There was indecision. Okay, we couldn't really see where the market was going, whether the market was going to move up or down. So there was indecision on the market. All right, and then we have three different types of doji. We have long-legged doji, we have gravestone doji, and we have dragonfly doji. Now, a long-legged doji, it opens at that point. The highest point is that one, the lowest point is that one, and then we had a close price at that point. A gravestone doji, it opens at that point. The highest point is that it went up to the highest point and then went down again. The lowest point is the same as the opening price or the buy price, and then we had a close price at a certain position. The dragonfly doji opened at that point, it went to the lowest price, and then it rose again. The highest point became the same point as the open price, and then we had a close price at that point. Okay, remember, a doji represents indecision. Okay, now I know a gravestone doji is bearish in an uptrend or bullish in a downtrend, and then the dragonfly doji is bearish in an uptrend and bullish in a downtrend. So a gravestone doji and a dragonfly doji, they cannot have the same functions or the same application as the hammers. Alright, now looking at this chart, we can see that the bears were taking over. Okay, the bears were taking over, and then we had movement, and then all of a sudden we had the bulls trying to take over, and then we had a long-legged doji. But we don't take the position at this point. We have to wait for confirmation, meaning we have to wait for a full bullish or bearish candle to form above the long-legged doji before we can take the position. And we can see at this point there was a full bullish candle that opened and closed above the long-legged doji, and that's the point where we will take the position. All right, and then we had the gravestone doji at this point. Okay, and guess what? It changed the market movement, and then we had a bearish movement. The bears took over and the market changed direction, and then we had another gravestone doji and the market changed direction. All right, and when you can take a look, you will see that we had a long-legged doji. It didn't really affect the market because the bulls continued after that. they continued until we had a dragonfly doji. The dragonfly doji changed the market direction. It changed the market direction, and then we had bearish movement. Okay, we had a downtrend until we had another dragonfly doji, and the market changed direction once again. Okay, now here's a little disclaimer. A hammer or a doji is only a signal that tells you a reversal is more likely to occur. Okay, it's not a sure thing. It's only a signal that tells you a reversal is more likely to occur. Okay, you don't have to see a doji or a hammer and just assume that a reversal is only going to occur. It's only a signal. It is best to use it with other technical tools before you can actually enter the market. Okay, don't just see a doji and assume the market is going to change. It's only a signal. Okay, is it definite that the market will occur? No. We all know that there is nothing definite when it comes to trading. Okay, these unique candlesticks are nothing more than potential signals. Okay, don't start trading the reversals and say that I told you that the doji or the hammers actually tell you that the market will reverse. No, I'm saying they are signals. Okay, they signal you that a reversal is more likely to occur, but do not trade reversals unless you're using other technical tools or technical analysis confirmations, right? Make sure you understand that. Okay, now let's look at buying and selling the market. Okay, now let's look at buying and selling the market. Okay, buying the market means you believe the market will rise. Okay, you only buy the market when you believe the market will rise. You are speculating on the rise in the value of a particular instrument between now and the future point. Okay, when you're buying gold, you believe or you think gold will rise over the next coming period. Okay, whether be it a minute, 1 hour, day, whatever, you believe it will rise. All right, when trading CFDs, you aren't really buying the physical asset. All right, you're only speculating on the market. Okay, when you're trading CFDs, let's say you're buying gold, you're not buying the physical gold. No, you're buying the instrument. You're speculating on the instrument. Okay, you don't have to have the physical gold. That is the difference between trading and investing. Okay, most of the time when you're investing in gold, most of the time you have to have the physical gold. Okay, when you invest in gold, you gotta have the physical gold. Maybe you'll have to put it in your safety deposit box in a bank somewhere. That is when you invest in gold. But when you're trading gold, you don't have to have the physical asset. You're only speculating on the price movement. Okay, now let's look at this currency pairs. Okay, let's explain this. I know a lot of people are mostly confused by the currency pair. Okay, now let's look at this Euro USD currency pair. Now if you're asking yourself, why am I always using Euro USD, it is only for consistency's sake. Okay, so you don't get confused when I introduce other currency pairs. That's why I'm using this one for consistency's sake. Okay, now it's Euro USD. Okay, the euro is the base currency. Okay, it is always constant. It is always €1. Okay, Euro USD is always constant. The base currency is always constant. The only changing currency is the other code currency, but the base currency remains constant. In this case, €1 will remain €1 forever. Okay, that is the base currency, while the code currency always fluctuates, goes up and down. Okay, now when the USD rises, you sell the euro pair. Now let's assume they say the Euro USD price is $1.52. It means for €1 you get 1.52 cents worth of Euro USD. Okay, I hope that makes sense. Now when USD falls, you buy euro. Okay, when they tell you that, okay, the the US dollar is going to fall, means you are buying euro. And when they tell you, the US dollar is going to rise, means you should be selling euro and buying the US dollar. Okay, when they tell you the US dollar is going to rise, you're selling the euro and buying the US dollar. Okay, now buying the markets. If you decide to buy the Euro USD markets, you believe euro will strengthen against the dollar. Okay, you buy at, let's just say you buy it at $1.45. Okay, at 1.4500. Okay, 1.4500, meaning 1 euro is equals to $1.4500. Okay, if the market rises to 1.4600, you profit because the market has just risen with 100 pips. Okay, you have made yourself 100 pips profit. Okay, now selling the markets. When you're selling the markets, you believe the market is most likely to fall in value over the next coming period of time. Okay, you are speculating on a fall in value of a particular instrument between now and a future point in time. When trading CFDs, you aren't really selling the physical asset. Okay, when you're selling gold, you're not selling the physical asset because you don't have it. You're only speculating on the price of that particular asset, instrument, or bond. Okay, now if you decide to sell the Euro USD market, you believe euro will weaken against the dollar. Let's say you sell at 1.3500 and the market falls to 1.3000. Okay, you have profited. Okay, you have made profit of 500 pips. Okay, you have just made yourself 500 pips. Let's look at a chart. Okay, now looking at this chart, we can see that this was our support. Okay, this was our support. The market came and bounced at this point more than 3 times. Okay, this becomes our support. This becomes our level. Okay, this, we can now assume that, you know what, the market has a tendency of behaving the same way at this point. What if it bounces again? Okay, if it will bounce at this point, that means when it reaches that point, I can buy because it has bounced 3 times, several times. Okay, so it means you can make your decision based on that. Okay, you can tell that, okay, at this point I can buy at this point. Why? Because the market bounced at this point several times. It bounced at this point several times. Okay, and if it doesn't bounce but it basically break through, you can have a stop loss just below this point. Okay, you can have a stop loss just below this point because you know the market is supposed to bounce here. But if it doesn't bounce and breaks through, you know, okay, this was a better idea, I'm out. Okay, and you close your position at this point, or you can have it at this particular point. You could have closed it here because you could see the market also used to bounce at this point. It bounced and it bounced again and then made a break here, but then this was almost a bounce again, so it might have been a great idea to actually close your markets at that point. Alright, so those are some of the things you're supposed to do. And then you could have sold at this point. You could have picked at this point and you decided, you know what, the market just decided, and then you would assume that, okay, it's gonna bounce here, what if we sell again? And then you would have taken the position and possibly closed it around here again. Okay, mostly because this was the point of which the market bounced a lot of times. Alright, now let's look at engulfing patterns. Okay, engulfing patterns It's the point where we had a long trend movement to whether to the upside or the downside, and then all of a sudden we have a big engulfing candle. Okay, a big candle that equals maybe 4 or 3 previous candles of that movement. Okay, in this case we have 1 2 3 4 5 6 okay candles, okay, that are somewhat bearish. Okay, they're red. Somewhat they're red, because even this one, I know it's green, but then it didn't really make much difference. So basically we have about 6 candles, and then the market changed direction and rose. Alright, that is the bearish engulfing candle. Looking at this point, can we see any bearish engulfing candle? Let's see. At this point, okay, we had a lot of bearish candles, and then we have one big engulfing candle. Okay, one big engulfing candle that covered more than a lot of candles. And at this point, we also had one big engulfing candle at this point, and then it also affected the whole entire thing. Okay, that might be a good signal to enter or exit the market. And I also had another big engulfing candle. Okay, so if you're already in the market, when you see an engulfing candle, it might be a best idea to get out, or it might be a best idea to get in if you haven't yet taken a position. Okay, disclaimer: a bearish engulfing candle only signals, it's only a signal that tells you a reversal is more likely to occur. Okay, now let's just say you see a doji, and then a big engulfing candle occurs as well. Now that's a really strong signal, because they both tell you that what there is a reversal that means more likely to occur. Okay, now is it definite that the reversal will occur? No, there is nothing definite when it comes to trading. It is only a potential signal. It only tells you that there is a signal. It is a piece of useful information that you can use to enter or exit the market. It is an indicator that there might be something, might be a reversal. Okay, it's not definite. Okay, and then we have the bearish engulfing candle. Okay, bearish engulfing pattern. We have bearish engulfing pattern. Now, a bearish engulfing pattern also occurs. It's also one bearish candle that outshines multiple bullish candle. Okay, we can see we have 1 2 3 4 5 6 7, so 6 candles. Okay, 6 bearish candles, bullish candles. We had 6 bullish candles, and then we had just one bearish candle, and then it just changed the whole movement of the what? Just changed the whole pattern, the whole market movement, just by one bearish candle. Alright, now looking at this chart, we can see that at that point we had a bearish engulfing candle. Okay, we had 1 2 3 4 5 bullish candle, and then we had one bearish engulfing candle. One bearish engulfing candle, and guess what? After that bearish engulfing candle, the market changed direction, and we had a downward movement over a period of time. Okay, now looking at this one as well, do you see any bearish engulfing candles? Yes, I think we do see one at this point. You see we had one. Okay, is that this one? Okay, 1 2 3 4 bullish candle, and then we had one bearish engulfing candle, and then the market continued over a period of time. Alright, until we had another bearish. Now, it might have been a great idea to actually close it before you even saw the whole entire candle. Alright, so we had one here, and remember, it also has its terms and conditions. Okay, it also has its terms and conditions. You need to make sure that you need to make sure that you understand how it operates. Remember, all right, because
also has its terms
it's also one
you
movement
need to
over
make
a
sure
long period of
that
time. Okay. Now a little disclaimer. You need to make sure that you understand how a bearish engulfing candle only occurs, is only a signal. One, you need to make sure period of time. Okay. Now remember, a bearish engulfing candle is only a signal that tells you a reversal is more likely to occur. It's not definite, okay? There is nothing sure. You can never be sure about anything when it comes to trading, okay? All these are signals, okay? When you have two things signaling you that the market is more likely to change direction, that's actually great information. This can help you to do that over a period of time, okay? It's only a piece of useful information you can use, okay, over a long period of time, which is why it is great to learn technical and fundamental analysis, okay? When you have two signals or two pieces of information that helps you change direction, you can use that over a long period of time, okay? Now, a bearish engulfing candle tends to be more violent than a bearish engulfing candle, okay, as people tend to panic more when the market is falling. Now, here's the thing, okay? There's this saying in the trading world that the market takes stairs, it takes an elevator when it's falling, okay? But you don't take the stairs when it's actually gaining, okay? When we're having an uptrend, it's actually an uptrend, it's a slow uptrend, and then we have a crazy downtrend. Now, a conclusion on the Japanese candlesticks. The Japanese candlesticks share light on what is happening to the instrument during a particular period of time, okay? They give us an idea of how the markets are moving over a certain time period, okay? Now remember, one Japanese candlestick represents a certain period of time. One Japanese candlestick can represent 5 minutes, it can represent an hour, it can represent a day, it can represent a week, it can represent 30 minutes, depending on the time frame you chose to actually trade that particular market. Alright, remember that one Japanese candlestick represents a time frame, okay? When you're trading the 5-minute time frame, you have to understand that one Japanese candlestick represents 5 minutes. When you're trading an hour, 1 hour time frame, you have to understand that one Japanese candlestick represents an hour, okay? Now, it is great to understand Japanese candlesticks because they are the ones you're going to use to trade the market. They are the ones you're going to use to analyze the market, okay? Whether you're trading fundamental or technical analysis, you need to understand the Japanese candlesticks, okay? They are quite important, okay? They show us previous price action, okay? They are an interpretative device only, potential signal guides. Like I said, your doji, your hammer, those are signals, okay? They aren't sure, they are not something you can say, you know what, I've seen a doji, that means the market's going to change. No, they are not a sure thing. They are only potential signals, okay? When used with other technical instruments, they are strong, okay, because they represent a stronger signal, okay? Use them with other technical indicators, okay? They do not predict how the market will behave in the future, but they offer guidance, okay? They offer us, we often use them as a method of gauging the probability of future performance, okay? Japanese candlesticks provide us with four pieces of information: the open price, the highest price or the highest value, the lowest price, or and the close price. Okay, they offer us the opening price of that particular time period, the highest price the market moved over that particular time period, the lowest price the market went, and the close price. Okay, so that is actually the whole wrap on that actually wraps up lesson 1 and 2. Okay, I do hope the summary was really fruitful for a lot of people, and I'll just take a water break and then I'll come and answer any questions you guys might have. All right. Are there any questions though? Because I think that's a wrap. I think we've wrapped up the whole entire thing. So if there are any questions, let's just wrap them up and yeah, and let's just wrap them up and see what happens. If there are any questions, let's answer them now. Let's just wrap them up and yeah, and let's just wrap them up and see what happens. If there are any questions, let's answer them now. Let's just wrap them up and oh yeah. Nice. That does. I think I'm done. I think we're done. If there are any questions, nah. Oh yeah. Nice. That does. I think I'm done. I think we're done. Is it poison? What? Good, good. Oh yeah. What does that mean? Is it poison? What? Good. Oh yeah. Yep. Is it? What?
If